Reducing your small business deduction grind, strategy number 2. The second strategy is making sure that your portfolio doesn't hold investments that are not tax preferred in your corporation. Deferred growth investments are still preferred in the accumulation phase of saving for retirement. Using investments that only create a capital gains tax tend to be the most efficient. 50% of the capital gain is sent tax-free to the corporate shareholder via their capital dividend account. The other half is taxed to the corp, but when paid to the shareholder as a dividend, there are provisions to recoup some of that tax that has been paid. Using investments that pay eligible dividends are subject to the Part 4 tax regime. What is that? It means that if the corporation funnels a dividend earned in an investment directly to their shareholder, the tax the corp paid is completely refundable and only personal tax will apply. Return of capital paid to an owner from their corp is typically treated as an ineligible dividend, still taxed lower than interest, but higher than an eligible dividend. Interest is not as efficient as eligible dividends or capital gains, but more efficient than foreign dividends. When interest is paid to a shareholder by way of a dividend, there is a portion of tax refundable to the corp, but will not recover as much tax as an eligible dividend. In this case, the system to integrate the corp and personal tax starts to break down. Now, let's look at what you will likely really want to avoid, which is a foreign dividend earning investment. When the corp receives that dividend from, say, something like a US stock, and then subsequently pays that to the shareholder, the total tax payable from the corp and personal side equals 61%. Remember, it's not necessarily what you make, but what you get to keep. Stick around for strategy number 3, and I'll see you next time.